So we're going to start by taking a look at closing stock adjustments, which appear in absolutely every final account question. And some years we have seen that there have been up to three adjustments that involve closing stock. Okay, so a couple of things before we begin. We need to look at the different types of prices that can appear on the paper. So there's a difference between cost price, selling price, and recommended retail selling price. So let's start by taking a look at cost price. So what is cost price? So cost price is how much it cost us to make the product if we are a manufacturing firm, or how much it cost for us to buy it from our supplier. So it could be our creditor if it was a credit purchase that we made. Selling price then, how much a business sells its products to their customers for. And then lastly, we have recommended retail selling price, so RRSP. So we see this a lot in exams. So if we received an invoice from a creditor showing an RRSP, this would be how much your supplier recommends that you sell the products to your customers for. And if it was an invoice sent to a debtor showing an RRSP, this means how much you recommend your customer to sell the products to their customers for. So it's very important that you know the difference between all of those prices. A lot of people will treat the closing stock adjustments correctly, but they will have the wrong price attached to it. So it's very, very, very important. Okay. So then we have to take a look at VAT then as well. So VAT, value added tax. So it's the obligation of the seller to collect the VAT and forward it on to the revenue commissioners. So if we were selling goods to our debtors, we collect the VAT and we send it to the revenue commissioners. If we buy goods from our creditors, we send them VAT and then they send it to the revenue commissioners on our behalf. So sold goods on credit to debtor, how does it look? So VAT is becoming a lot more frequent in the exams. We're starting to see it a good bit more. All you need to know is that we record VAT on the same side as the item it is attached to. So goods sold on credit to debtor. So you credit the sales account, you credit the VAT account with the VAT figure. So the sales account is the VAT exclusive figure. VAT account is just whatever the VAT percentage was, and then in the debtor the whole amount goes in there, the sales amount plus the VAT amount, so the VAT inclusive figure. If we were looking at purchase goods on credit from creditor, we would have a purchases account and that would just be the VAT exclusive figure, so whatever the purchases are without VAT. We'd put the VAT on the debit side of the VAT account. And in the creditor account, we would put all of it. We would put the purchases and the VAT, so the VAT inclusive figure there. So with closing stock, we've seen 4 different types of adjustment, okay? So we can have maybe damaged stock at the end of the year. We can have goods in transit at the end of the year. So there's goods in a van somewhere and it hasn't been adjusted for. We have sale or return. And then we have closing stock of a manufacturing firm. So with damaged stock, basically we just have some damaged stock at the end of the year. So we have, for example, stock at cost on the 31st of the 12th, whatever year, was €90,000. This figure includes damaged stock which cost €10,000 but which now has a net realisable value of €8,000. So how do we deal with this? So we adjust the closing stock in the TPL and the balance sheet as follows. So we reduce the closing stock by the amount of damage to the stock and add back the realisable value, so how much it's actually worth. So in this example, we have closing stock 90,000 minus 10,000 plus 8,000, or you can just say 90,000 minus 2,000. Either or is fine to get the marks there. So how does it look in an exam? So this is just an example in the sole trader account. So you've got closing stock up here in the trading. You've got 90 minus 10 plus 8, or again, you can have 90 minus 2. And then you have to put your closing stock into your current assets in your balance sheet. So you'll see I say here just as per TPL. So whatever figure that you get here at the end of all your adjustments, if you just bring it right over here, they tend to give you your own figure for that. So you don't have to do the workings here as well. Right, goods in transit. So what's that all about? That's goods in transit at the end of the year. So goods are in transit, so that means they're in a van, a delivery van, either coming to you or going away from you. So you've either sold goods and they are en route to your debtor, so that means there is an invoice sent, or you've purchased goods and they are en route to you from your creditor, and that is an invoice received. So the first one there, sold goods and they are en route to your debtor. So for example, no record has been made in the books for goods in transit on the 31st of 12th. The invoice for these goods has been sent, showing a credit sale of 18,000, which is a markup on cost of 25%. Okay, so what will we do? We'll adjust the closing stock in the TPL and balance sheet as follows. So we'll reduce the closing stock by the cost of the goods sold. Okay, so that's 14,400. How did we get that? Because the selling price was 18,000, and we'll divide it by the 125 and multiply it by the 100. We will increase sales by 18,000 in the TPL, and we will increase debtors by 18,000 in the balance sheet. So that is how we would record goods on transit if we have sold goods and they're en route to debtor. Now this has never appeared in a past paper question, okay? They usually do the other way around, which is the creditor, but you have to be very, very, very careful. Has the invoice been sent? If it has, that's to your debtor. If it's been received, that has been received from your creditor. So just be very careful, just in case. So you're not going to see loads of these in the past exam questions now. All right, so closing stock, we minus 14,400, and in the balance sheet, we'll just have as per TPL. Then in the sales, we'll add 18,000, and then the debtors will add 18,000. So next we'll look at the one that has come up quite regularly. So purchase goods and they are en route to you from your creditor. So for example, no record has been made in the books for goods in transit on the 31st of 12th. The invoice for these goods was received, showing the recommended retail selling price of 23,000, which is cost plus 25%. Okay, so we adjust the closing stock in the TPL and the balance sheet as follows. So we increase the closing stock by the cost of the goods that were bought. Okay, so 18,400. So 23,000 is how much our creditor has recommended that we can sell them for. So we take that 23, we divide it by 125, and we multiply it by 100 to get the cost of the goods bought. So 18,400 there. Then we increase purchases by 18,400 in the TPL, and we increase creditors by 18,400 in the balance sheet. So how's this going to look? So your closing stock plus 18,400 there, and then your closing stock will be as per TPL there in the current assets in the balance sheet. The purchases, we will add 18,400 to our trial balance figure, and creditors will add 18,400 to our trial balance figure. So that's how goods in transit looks. The next one, sale or return. Students do really poorly at this in exams. It's very often that they will get this wrong, and it's such a pity because it's a very quick adjustment to do if you understand what you have to do. So sale or return, what is it? So this is an agreement between the seller and buyer that states that goods that are not sold will be taken back without having to be paid for. So in these adjustments, the business's bookkeeper enters a sale or return agreement on the 31st of the 12th as a credit sale or a credit purchase by mistake, and it's your job to now fix his or her error and unwind it. So if we were to rewind a credit sale, this is what the bookkeeper did by mistake. So they will have taken the cost price away from the closing stock, they will have added the selling price to sales, and they will have added the selling price to debtor. So how are we going to fix it then? We're just going to do the exact opposite. So the closing stock, we will add the cost price. Sales, we will minus the selling price. And debtors, we will minus the selling price. So for example here, goods were sent to a customer on a sale or return basis on the 31st of 12th. These goods were recorded in the books as a credit sale of 28,000, which is a markup on cost of 25%. Okay, so let's take a look at what we would do here. So we would adjust the closing stock in the TPL and balance sheet as follows. So we would increase the closing stock by the cost of the goods 22,400. So that's the credit sale divided by the 125 multiplied by the 100. So that's the cost price there. We will decrease the sales by 28,000 in the TPL, and we'll decrease debtors by 28,000 in the balance sheet. So this is how it would look. So closing stock, we'd add the cost price of the goods back in the trading account, and then as well, obviously the closing stock in the balance sheet will be the same as the TPL. The sales will minus the 28,000, the selling price, and the debtors will minus the 28,000. So this is a very popular adjustment. So I would urge you to really make sure you understand what you're doing here. So people will treat it correctly, but they'll just use the wrong figures. So make sure you understand that. So to rewind a credit purchase then, so what did the bookkeeper do by mistake? So if there was a credit purchase that the bookkeeper put in by mistake, they will have added the cost price of the goods to the closing stock, to purchases, and to creditors. So how will we fix it then? We'll take the closing stock away from, or the cost price away from closing stock, we'll take the cost price away from purchases, and we'll take the cost price away from creditors. So an example here, it was discovered that finished goods had been received from a supplier on a sale or return basis. These goods had been recorded as a credit purchase of €20,000. Okay, so how do we deal with it? So we adjust the closing stock in the TPL and balance sheet as follows. Decrease the closing stock by the cost of the goods, €20,000. Decrease purchases by 20,000 in the TPL, and decrease creditors by 20,000 in the balance sheet. So this is how that would look. So closing stock in the trading minus 20, and closing stock as per the TPL in the balance sheet. Purchases minus 20,000 and creditors minus 20,000. So the last one, so the fourth type of closing stock adjustment that has appeared. So we've got manufacturing. So in manufacturing accounts, the business produces their own products. So in other accounts, the sole trader and company, they just buy the products and then they resell them. So the same type of issues can arise in manufacturing accounts with the closing stock, like damaged goods, goods in transit, and sale of return. You just need to know where to record the three different types of closing stock. So in manufacturing accounts, we've got closing stock of raw materials, closing stock of work in progress. So imagine they make hoodies and they just have a half finished hoodie here, no arms here. And then they have finished goods. So that is the finished product there. So we put the raw materials and the work in progress into the manufacturing account. And then we put the finished goods into the trade and profit and loss account. But we put all three types of closing stock into the balance sheet. So this is how this would look. So we've got the closing stock of raw materials up here in the manufacturing account, also in the current assets. We've got closing stock of work in progress in the manufacturing account, also in the current assets in the balance sheet. And then we've got closing stock of finished goods in the trading profit and loss, and then we also have it in the balance sheet as well in the current assets. So let's get started now and have a look at all of the past exam closing stock adjustments. All right, so as I said, you will see up to 3 closing stock adjustments in exams. So you might see 1, very common to see 2, and in some cases we've seen 3. So it's very important to get this all absolutely nailed and know how to treat each and every one of them. So number 1 here in the 2021 question 1A. So stock at cost on 31st of the 12th, 2020 was 72,100. This figure includes damaged stock which cost 12,400 but which now has a net realisable value of 25% of cost. And then number 2, goods were sent to a customer on a sale or return basis on the 31st of the 12th, 2020. These goods were recorded in the books as a credit sale of 28,000, which is a markup on cost of 25%. Okay, so we'll take the first one first. Stock at cost 31st of 12th was 72,100. This includes damaged stock, which cost 12,400, but which now has a net realisable value of 3,100. So that's how that will look there in the trading account, and then we'll just put the closing stock as per the TPL in the current assets. And then number 2, Goods were sent to a customer on a sale or return basis on the 31st of the 12th, 2020. These goods were recorded in the books as a credit sale of 28,000, which is a markup on cost of 25,000. So basically, the bookkeeper shouldn't have recorded this as a credit sale. So we have to rewind the credit sale. So we will add the cost price back to the closing stock, which is 22,400, and we will take the selling price, 28,000, away from sales and away from debtor's figure. So that's the 2021 question 1A. Okay. Next then there was 2 final accounts that year, so 2021 question 1B. So it was a manufacturing account. So you can see here they had stocks on hand at 31st of the 12th. They had raw materials, they had work in progress, and they had finished goods. So they had another adjustment, number 3. Finished goods were sent to a customer on the 31st of the 12th, 2020 on a sale or return basis. These goods were recorded in the books as a credit sale of 16,000, which is a markup on cost of 25%. Okay, so let's get going. So we have closing stock of raw materials, 52.4 here. We have closing stock of work in progress, 24.9 here. Then we have finished goods in the trading account. And then we've all 3 there. Now you can club them up here like this: closing stock, raw materials, work in progress, finished goods, but I would put each figure. So if you want to save space, that's very easy to do, that's fine, but indicate what figure is which type of closing stock. Next we have finished goods were sent to a customer on the 31st of the 12th, 2020 on a sale or return basis. These goods were recorded in the books as a credit sale of 16,000, which is a markup on cost of 25%. So we will add the cost price of the goods back, okay, because we have to unwind the credit sale here. So 12,800 is 16,000 divided by 125 multiplied by 100 to get the cost price. Then we will reduce the sales and the debtors by 16,000, and that is your closing stock finished for that question. So 2020 exam, stock at cost on 31st of the 12th, 2019 was 69,800. This figure includes water damage stock, which cost 10,600, but which now has a net realisable value of 15% of cost. Number 2, no record has been made in the books for goods in transit on the 31st of the 12th, 2019. The invoice for these goods was received showing the recommended retail selling price of 24,500, which is cost plus 25%. Okay, so stock at cost 69,800. We're going to minus the 10,600, and then we're going to add whatever the amount is that it's worth back with, so plus 1,590. That's that adjustment done then when you put the current assets as per our closing stock as per TPL in the current assets. Number 2, no record has been made in the books for goods in transit on the 31st of the 12th, 2019. The invoice for these goods was received from a creditor, showing the recommended retail selling price of 24,500, which is cost plus 25. So you've got goods on your way to you from your creditor. They recommend that you settle them for 24,500, which is 125% of what you bought them for. So if we have goods in transit, we need to add the amount to purchases, to closing stock, and to creditor. So the cost price to you was 19,600. So that is 24,500 divided by 125 multiplied by 100. So your purchases, to your purchase figure, you add 19,600. To your closing stock figure, you add 19,600. And to your creditors figure, you add 19,600. Now, 2019. So number 1, stock at cost on 31st of the 12th, 2018 was 75,400. This figure includes damaged stock, which cost €6,000, but which now has a net realisable value of 75% of cost. And number 4, it was discovered that goods had been sent to a customer on the 31st of the 12th, 2018 on a sale or return basis. These goods had been entered in the books as a credit sale of $7,500, which is a markup on cost of 20%. Okay, so let's get going. So closing stock, 75,400 minus 6,000 plus 4,500 in the TPL, and then in the balance sheet, closing stock as per TPL there. And number 4, it was discovered that goods had been sent to a customer on the 31st of the 12th, 2018 on a sale or return basis. These goods have been entered in the books as a credit sale of 7,500, which is a markup on cost of 20%. Okay, so the first one, closing stock 75,400 minus 6, and we add the realisable value, and we'll also write closing stock as per TPL in the current assets. Adjustment 4. So we sent goods to a customer on a sale or return basis. So we shouldn't enter that as a credit sale, but it was entered as a credit sale by the bookkeeper. So we need to unwind it. So how will we do that? Well, we need to add the cost price back to closing stock, and we will subtract the 7,500 from sales and from debtor. So the cost price is 7,500 divided by 120 multiplied by 100. So cost price plus 6,250 onto closing stock there, and the sales we minus from the trial balance figure, we minus 7,500, and then 7,500 from our debtors figure in the trial balance. So that's 2019. 2018, a manufacturing account. So adjustments number 1 and 2 here. So stocks on hand at 31st the 12th, 2017, finished goods, raw materials, work in progress. Number 2, it was discovered that finished goods had been sent to a customer on the 31st of the 12th, 2017 on a sale or return basis. These goods had been recorded as a credit sale of 17,500, which is a markup on cost of 25%. Okay, so the first one, stocks on hand, finished goods, that's going to go in the TPL, but we've got raw materials 31,500 here, and we've work in progress 40,200 here. The finished goods are here 68,100, and all 3 of them will go in current assets, the closing stock of all those 3 there. Number 2, it was discovered that finished goods had been sent to a customer on 31st the 12th on a sale or return basis. So we should not enter that as a credit sale, but unfortunately the bookkeeper recorded them as a credit sale incorrectly. So credit sale was 17,500, which is a markup on cost of 25%. So we want to find what was the cost price of that. So 17,500 divided by 125 multiplied by 100. So the closing stock of finished goods plus 14,000 here, and the sales we're going to minus the 17,500 from the trial balance figure, and debtors we're going to minus 17,500 from the trial balance figure. Next year, 2017, 2 adjustments again. Number 1, stock on 31st the 12th, 2016 at cost was 76,500. This figure includes damaged stock, which cost 4,500 and now has a net realisable value of 3,000. And number 9, no record has been made in the books for goods in transit on the 31st of the 12th, 2016. The invoice for these goods has been received showing the recommended retail selling price of 16,000, which is cost plus 25%. Okay, so let's have a look. So stock at cost 76,500 minus the damaged stock plus the realisable value here. We put that in the trading account, and then we write closing stock as per TPL in the current assets. Number 9, no records being made for goods in transit on 31st of 12th, 2016. The invoice has been received. Received from who? Received from creditors, showing the recommended retail selling price of 16,000, which is cost plus 25%. Okay, so recommended retail selling price of 16, which is cost plus 25. So 16 divided by 125 multiplied by 100 will be our cost price, 12,800. So we add the 12,800 to the purchases figure, we add it to the closing stock, and we also add it to our creditors. And that's that adjustment done. 2016, 2 adjustments in manufacturing accounts. So stocks on hand to 31st the 12th, finished goods, raw materials, work in progress, And number 4, it was discovered that finished goods had been sent to a customer on 31st of the 12th, 2015 on a sale or return basis. These goods have been entered in the books as a credit sale of 15,000, which is a markup on cost of 20%. Okay, so we have here closing stock of raw materials 36.1, closing stock work in progress 34.2. They're both in the manufacturing account, and the finished goods 77.6 will go in the trade and profit and loss. All 3 of them will go in the manufacturing account, and it's totally okay to put them all together there. Number 4 then, it was discovered that finished goods had been sent to a customer on 31st of 12th, 2015 on a sale or return basis. These goods have been entered in the books as a credit sale of 15,000, which is a markup on cost of 20%. So sale or return to a customer, that needs to be unwound because they were entered in the books as credit sale incorrectly by the bookkeeper. So we need to rewind that credit sale. So we will add the cost price back to the closing stock of finished goods, and we will subtract the selling price from sales and from debtors. So the cost price is 15,000 divided by 120 multiplied by 100, which is the cost price of my goods, 12,500 there. And then the sales minus 15,000, trial balance figure minus 15,000, and debtors trial balance figure minus 15,000. So that is that. 2015, only one adjustment here. Stocks at 31st the 12th, 2014 at cost were 80,400. This figure includes damaged stock, which cost 6,600, but which now has a net realisable value of 3,200. So nice and easy here. 80,400 minus 66 plus 32, and then we write that in the current assets closing stock as per TPL as well. 2014, one adjustment, but there's a goods in transit put into our closing stock here. So stock at 31st the 12th, 2013 at cost was 80,000 euro. No record has been made for goods in transit on the 31st the 12th, 2013. The invoice for these goods had been received showing the recommended retail selling price of 4,800, which is cost plus 20%. Okay, so we have here closing stock 80,000 plus 4,000, okay, and then closing stock current assets there as well. Now, how do I get 4,000? So we've received an invoice. Who do we receive an invoice from? Our creditor. So we have bought goods from our creditor. Now the selling price, the recommended retail selling price of them, 4,800, is cost plus 20. So 4,800 divided by 120 multiplied by 100 is 4,000 euro there. And then we add that to our purchases figure. So whatever our purchases figure was in the TPL plus 4,000. And we'll also add it to the creditor plus 4,000 there. Now, 2013 manufacturing account. So stocks in hand 31st the 12th, 2012. So finished goods, raw materials, work in progress. The finished goods figure includes stock which cost 4,400 but now has a net realisable value of 2,500. And number 2, finished goods sent to a customer on December 31st on a sale or return basis were treated incorrectly as a credit sale. The recommended retail selling price of these goods was 6,000 euro, which is cost plus 20%. Okay, so stocks on hand, finished goods, raw material, work in progress, and the finished goods figure includes stock which cost 4,400 but now has a net realisable value of 2,500. So we have closing stock raw materials 35.7, closing stock work in progress 27.4. Alright, and then we've got the finished goods 79.4, but the finished goods figure includes stock which costs 4.4 but now has a net realisable value of 2.5. So that's how we adjust it there in the trading profit and loss. And then in the current assets, we have the closing stock of raw materials, work in progress, and finished goods there. Then we have finished goods sent to a customer on December 31st on a sale or return basis were treated incorrectly as a credit sale. The recommended retail selling price of these goods was 6, which is cost plus 20. Okay, so we then take our finished goods, all right, and we add the cost price of those goods back, okay, because we should never, the bookkeeper should never have recorded this as a credit sale. So we have to unwind the credit sale. So we add the cost price of 5,000 back to closing stock. That's 6,000 divided by 120 multiplied by 100. And we subtract the selling price from sales, and we subtract the selling price from debtors. Now in 2012, stocks at 31st of 12th 2011 at cost were 81,200. This figure includes damaged stock which cost 5,400 but which now has a net realisable value of 2,300. So we have closing stock here, 81,200 minus 54 plus 23, and that goes also into the current assets. So whatever we get in the TPL, we'll put in the current assets. So that was a very quick one. 2011, another manufacturing account. We have stocks on hand at 31st the 12th 2010. We've got finished goods, raw material, work in progress. And the figure for finished goods includes items which cost 6,000 to produce but now have a sales value of 4,000. And we've two more adjustments here. So this is the first one that we have three here. So number 6, it was discovered that goods which cost the firm 5,400 to produce were sent to a customer on a sale or return basis. In error, these goods were charged to the customer at cost plus 25%. And number 7, an invoice has been received for raw materials costing 15,000 which were in transit on the 31st of 12th 2010. No record has been made in the books. Okay, so let's get started. So the first one, simply put in the closing stock of raw materials and work in progress into the manufacturing account, and then the 85,000 into the trading account, and then all three need to go into the balance sheet. The second one then, this is a sale or return. So goods were sent to a customer and they were charged incorrectly as a credit sale, so we need to unwind the credit sale. Now this is a little bit different. It cost the firm 5,400 to produce. So that is the cost of the closing stock. So we're going to add the 5,400 back to the cost of closing stock. And then they were charged to the customer at cost plus 25. So 5,400 is the cost price. So 125% of 5,400 is what the selling price was. So from the sales, we will minus 6,750. And from debtors, we will minus 6,750 as well. Okay. Then, third one. An invoice has been received for raw materials costing 15,000, which were in transit on the 31st of 12th 2010. No record has been made in the books. All right, so invoice for raw materials. Who do you get an invoice from? You get an invoice from your creditors because you have made a credit purchase from them. So an invoice is a credit document and we've received it from a creditor. So raw materials. So purchase of raw materials, 15,000 there added to the trial balance figure, but they were in transit at the end of the year. So that means we have to add 15,000 to the closing stock of raw materials as well. And then we also add it to our creditors account. Okay, so our creditors figure from the trial balance plus our 15,000. So that is 2011 closing stock one done. So just keep it in mind that you can see up to 3 closing stock adjustments. So then 2010, number 1, stock at 31st of the 12th 2009 at cost was 75,400. This figure includes damaged stock which cost 8,200 but which now has a net realisable value of 3,400. Okay, so nice and easy one. Closing stock 75,400 minus 8,200 plus 3,400, and then in our current assets we have closing stock as per TPL. 2009 we've got 2 adjustments. So stocks in hand 31st the 12th 2008, we've got finished goods, raw materials, work in progress, and the figure for finished goods includes items which cost 5,000 to produce but now have a sales value of 3,000. And number 6, it was discovered that goods which cost the firm 6,500 to produce were sent to a customer on a sale or return basis. These goods were charged to the customer in error at cost plus 20%. Now, in the later manufacturing accounts, actually the last one had this as well. I should have mentioned it to you. You don't see the 31st of the 12th there, but they have started to put in the 31st, the 12th in the newer manufacturing accounts, and I think it's a bit poor of them to not have written the 31st, the 12th in here. Okay, so I actually, like, I know in more recent years you will see 31st, the 12th. So when you see goods 31st, the 12th, you know, you should be adjusting your closing stock. But this is a little bit unclear, but it is, they did want you to treat it as closing stock as well. So just that little point to make there. Okay, so 2009, so we've got finished goods, raw materials, work in progress. So raw materials and work in progress goes in the manufacturing account, and finished goods goes in the TPL. And the figure for finished goods includes items which cost 5,000 to produce, but which now have a sales value of 3,000. And then the second one, it was discovered that goods which cost the firm 6,500 to produce, so that is the cost price, were sent to a customer on a sale or return basis. These goods were charged to the customer an hour at cost plus 20%. So the 6,500 is the closing stock, so that will be added back to closing stock. So the bookkeeper recorded this as a credit sale by accident, so we need to unwind it. So we need to add the closing stock back, the cost of the closing stock back to closing stock. We need to subtract the selling price, 7,800, from sales and from debtors. How did I get the 7,800? It was the 6,500 multiplied by 120%. And that's the 2009. 2008. Stock at 31st the 12th 2007 at cost were €75,000. No record had been made in the books for goods in transit on the 31st of the 12th 2007. The invoice for these goods had been received showing the recommended retail selling price of 6,000, which is cost plus 25%. Okay, so how's this going to look? So goods in transit on 31st, is it goods that we sent or goods that we're receiving? So the invoice for these goods have been received. So we are receiving these goods. We have received an invoice from our creditor who sold us goods on credit. So invoice is a credit document, okay? So bought goods on credit. So closing stock, we add the 4,800, all right? Because that is the actual cost of the goods from the creditor. We'll put our closing stock into our current assets as well. And then our purchases and our creditor figures from the TPL need to have 4,800 added to them. 2007, very easy. Stocks at 31st the 12th 2006 at cost was 85,200. This figure includes damaged stock which cost 6,600 but which now has a net realisable value of 2,600. Okay, so we have closing stock minus 66 plus 26, and then in the trading account, and then in the current assets in the balance sheet, closing stock as per TPL. 2006, so number one, stock at 31st the 12th 2005 at cost was 72,500. No record had been made in the books for goods in transit on 31st the 12th 2005. The invoice for these goods had been received showing the recommended retail selling price of 7,000, which is cost plus 25%. Okay, so invoice has been received. Received from who? It's been received from a creditor. So they sold us the goods on credit and then they sent us the invoice to say this is how much you owe us. So closing stock 72.5 plus 5.6. How did I get 5.6? Well, the invoice shows recommended retail selling price of 7,000, which is cost plus 25. So the cost price to us was also on that invoice, but the examiners just aren't telling us that. But 7,000 divided by 125 multiplied by 100 is the cost price. So we add 5.6 to the closing stock. We put the closing stock as per the TPL into the current assets, and then we add the 5.6 to the purchases figure, and we also add it to the creditors figure. Now, 2005 manufacturing account. So again, we have just the three types of stocks, and then we have the figure for finished goods includes items which cost 7,000 to produce, but now has a sales value of 4.5. And then number 4, it was discovered that finished goods which cost 8,000 to produce were invoiced to a customer on a sale or return basis. These goods had been entered in the books as a credit sale at cost plus 20%. Okay, so you're just throwing the raw materials and work in progress in the manufacturing account, and then you're throwing the finished goods into the trading profit and loss, and you are accounting for the 7,000 being reduced to 4,500, so minus 7,000 plus 4,500, and you're putting all three types of closing stock into the current assets. And like the last manufacturing account, I said they didn't mention 31st to the 12th in this, which was a bit shoddy. It's a bit bad, but they have started to do that. They have started to mention 31st to the 12th in the newer manufacturing accounts, but this was a sale or return which was incorrectly treated as a credit sale, and we just need to rewind the credit sale. So 8,000 to produce, so that is the cost price. So we're going to add 8,000 back to the closing stock of finished goods. So 8,000 to produce, multiply that by 120% to get the selling price. So we're going to minus from the sales and the debtors the 9,600. Okay, so that is that done. 2004 then, one tiny little adjustment. Stock 31st of the 12th 2003 at cost was 85,000. This figure includes old stock which cost 8,000 but now has a net realisable value of 60% of cost. Okay, so we just put 85,000 minus 8,000 plus 4,800 into the trading account, and then we put closing stock as per TPL into the current assets. 2003, again only one tiny one. Stock at 31st the 12th 2002 at cost was 74,500. This figure includes damaged stock which cost 6,600 but which now has a net realisable value of 1,900. So we've got 74,500 minus 66 plus 19, and so that goes into the trading account, and it also goes into the current assets closing stock as per TPL in the balance sheet. Last one then, 2002, we only have one here. So stock at 31st the 12th 2001 at cost was 66,000. This figure includes old stock which cost 7,000 but has a net realisable value of 70% of cost. So we have closing stock here 66,000 minus 7,000 and plus the 70% of cost, which is 4,900, and then we have that in the current assets closing stock as per TPL there as well. So that is all of the closing stock adjustments from 2021 exam back to 2002. So just take note of the 4 different ways that it can be asked, and make sure you know the difference in how you treat them, and obviously the difference in the different types of costs that you would see written in an exam question.